watching Inside Automotive with Jim Fitzpatrick.
At the end of October, Sonic Automotive, one of the nation's largest automotive retailers, held their third quarter earnings call. Today, we're taking a look at the numbers and getting an overview of the business operations with President of Sonic, Mr. Jeff Dyke. You've seen him here before on CBT News. Jeff, thanks so much for joining us once again on the show.
Certainly glad to be here, Jim. It's always a pleasure.
Sure. So congrats. A lot of good news coming out of the Sonic camp. Talk to us about that.
Yeah, a really solid quarter. The pre-owned business is getting better. Prices are dropping. As you know, we run a really tight day supply, so it's a quick turnaround for us. Just a great quarter, both on the franchise side and the EchoPark side. And our power sports business is not doing too bad either. So it's a lot of fun. We're picking up momentum. Our fixed operations business is good. The new car business is good. Margins are tough. But that was to be expected. We're actually ahead of plan for our margins. So all in, not a bad quarter, and we're looking for more of those.
Sure. It looks like Sonic reported a third quarter net income of $68 million, however, down 22% year over year. Talk to us about that.
Yeah, look, it's all 100% coming out of the new car PUR, which was down some $1,900 a car. Yeah. But that was in our plan. We were well ahead of our plan. And that's what's important here. The market is changing. It's moving around. New car inventories are growing. This month, we're north of 10,000 new cars in stock. It's the first time we've been north of 10,000 since 2018.
Yeah.
But overall, we're very pleased where the business is, and we have a hedge in EchoPark. And so our EchoPark business is getting a lot better, as you saw the numbers. Just an amazing quarter.
Yeah.
We grew, improved our bottom line. And we intend to keep doing that. We've announced and reiterated our target of being EBITDA positive by the first quarter. We're on track to do that. We'll have another strong fourth quarter. And so all thumbs up for us. We're very excited about where the business is.
That's great. In fact, EchoPark segment gross profit was $52 million, up 22% year over year, right? What do you attribute that to?
Well, that's an all-time record for us,
yeah.
And absolutely. Look, prices are dropping. We've always known the EchoPark model prior to COVID, some of the most profitable stores in the entire company. So we know the model works. The problem is the inventory ran out. We made some tough decisions in June to hibernate some stores, which we did. And that allowed us in our buying team, it's just fantastic at what they do, buy enough cars and mix for the stores that were left open. As a result, we're selling more cars with fewer stores. Margins are significantly better. And that's continuing on into the fourth quarter, and we expect it to just continue to get better as new car inventory begins to expand and accelerate, which it's doing. We're going to see new car inventory grow in November and December, from my perspective. I think we'll see that happen into next year. It's going to put pressure on new car margins, so we'll have less overall new car gross next year. But we have a hedge in that. Our used car business is getting better. Our fixed operations business is great. F&I is performing really well. And EchoPark is coming, really coming alive. So with that, it makes it a lot of fun.
Sure. That being said, are there plans to reopen those stores that you closed?
Yeah, at some point there is. Really, the way I'm looking at it is when we buy most of our cars from the auction, call it 80%, and we really need those prices that on average to be south of 23,000. We're just below 25,000 now, but that's down from 31,000 at the high. So to have an affordable payment for the consumer, really want to see that price drop below 23. When that happens, you'll see us put our foot on the gas pedal, begin to reopen stores, and back on our march to coverage of 90% of the country across the board. So something that we'll see, and we'll be very, very patient and methodical as the new car inventory rises and used car prices begin to drop. I think there's 18 to 24 months of kind of bumpy road. When it comes to pre-owned pricing, you're going to see some drops like we're seeing right now in the marketplace, but I think you'll see some increases as we get into March as normal seasonality kind of begins to return for pre-owned. But there's going to be some ups and downs, and I think it's another 18 to 24 months before we're really able to put our foot on the gas pedal.
Okay. And do you attribute that to the high interest rates that are out there?
Not really. Okay. Interest rates move around, and they have over my whole career, and it really slows the business down, maybe here or there. I attribute it most of that to availability of inventory,
Okay.
especially the nearly new category, 1 to 4 year old cars under 50,000 miles. That's really the focal point. We need that inventory to return. More leasing on the new car side will play a role in that. And we need the prices to drop, and more new car inventory on our lots is going to play a big role in dropping those prices.
Sure, sure. During the third quarter, Sonic repurchased roughly 1.7 million shares of stock. Talk to us about that.
Hey, put your money where your mouth is. We believe in our company. We believe in what we're doing. We believe in where we're headed with the business, and the stock's on sale. And so we're going to allocate capital into different areas of the business. One of them is going to be our stock. And when we see an opportunity to buy stock, we'll do that accordingly. It's the same thing as if though we find a new car dealership or group to buy, or a power sports business to buy, or opening an Echo Park store. We allocate that capital where we think we're going to get our best return on investment. Sure.
Has the power sports business been a surprise to you? On the outset, that wasn't something that Sonic, it seemed to me, was getting into, but you have gotten into it, and it sounds like you're pretty bullish on it.
Well, it has been a surprise, to be honest with you, Jim. We had an amazing quarter. Sturgis was fantastic.
Yeah.
Third best Sturgis by revenue and profit ever. And so really, really excited. We did 550 bikes in like 2 weeks.
Oh my gosh.
So yeah, just an amazing, amazing event. And we're learning. And so as we learn and we gain more confidence in the industry, we're going to grow. And I would expect to see us do a few more acquisitions, probably in the coming 12 to 18 months. Our playbooks are being developed. Our processes are being developed. We're bringing technology to the business, but it's going to take another 12 months to really bring all that to life. But so far, so good. The margins are great. The volume's good. What we're paying for the business is good. It all kind of fits. And we can take our skill sets that we've honed over the years in the automotive business, in particular around inventory management, apply it to power sports and see a nice return. We're beginning to see that.
And there's so many similarities between autos and power sports, right? I mean, I'm sure it's got a lot of the same characteristics, F&I, and obviously fixed stops and everything else, right? I mean, it doesn't really matter as long as it's got a wheel on it, or in some cases.
That's true. Bruton used to tell us we sell 4 wheels, not 2 wheels, guys. But he would love this business and the returns.
Sure.
And it's an amazing business. I think it comes down to your ability to manage inventory and manage inventory well. It's something we do well. We have the technology, and we're bringing that characteristic to the culture and the environment. And power sports is going to make a big difference in their bottom line and how many units we sell.
Yeah, for sure. A friend of mine owns a string of dealerships and a number of power sports stores. So we started kind of dressing up the new car department, or I should say the new car showroom, with trailers of jet skis and motorcycles behind them to kind of cross-pollinate. Have you taken that approach with any stores?
100%. There's tons of opportunities there. There's opportunities to cross-pollinate trucks and those CUs too. So there's just a lot of opportunity for us. There's a lot of opportunities for us in our speedway business and to do rallies and things of that nature.
Sure.
So we have all kinds of great ideas, but first comes first. We're going to make sure we get our arms around the business. We have our processes in place and our playbooks in place, and then we'll start expanding.
Sure. We've seen Lithia and some of the other publics jump out there and acquire stores. What does that look like on the acquisition front? Any deals cooking?
Yeah, there are a few here and there. We're watching our competition grow and do some things, and we're looking at a few deals. I still think the prices are high. And I think there's an opportunity as we move into next year for those to settle down a little bit.
Yeah.
And when that happens, you'll probably see us jump back into the market. We're just finishing, really swallowing the RFJ acquisition that we had 18 months ago or so. And so that's been a big acquisition for us. All those processes are in place now and the business is running well. And so it'll be time for us to start taking a look at some other businesses as we move into next year. And some of the prices settle down. I still think the times earnings and what people are paying are a little high. Yeah. But that doesn't mean that we're not in the market looking at opportunities.
Yeah, it seems as though I talked to all of the people in the buy-sell business, and They say that there's still dealers out there that still think that it's 2021, or 2022 with regard to what they want for their dealership. So you're right. I do think that we're going to start to see those numbers come down on stores in the sense that gross profits are down and things are starting to normalize a little bit, right?
Yeah, those that are selling certainly want to have the back half of 20, all of 21 and 22, and the first half of 23 is how we measure the business.
Yeah.
But you got to look at 18 and 19, and you certainly got to look at what's happening on the back half of 23 and what we're projecting for 24. When you include that, we want to get another year under our belt or so before we start writing checks again. So we'll see how it goes, but certainly there are opportunities out there to be had.
Sure. Well, it sounds like from the news today that the strike is over. Did that have much of an impact in your business thus far? And what do you think it'll have moving forward? I mean, it will take a while for things to get back, or where does that stand?
Not really. We bought up parts ahead of the strike a little bit, so we raised our day supply. So we're fine through the end of the year. I'm assuming, and I think that they'll get the lines open quickly and start producing inventory. They need to do that.
Yeah.
If it causes anything, it may cause a little disruption back half of December and in January, but we're expecting that to all get resolved, and we'll be back business as usual.
Yeah, that's great. One last question, and then I'll let you go for the day. Where do you stand on EVs today? I know I say that to dealers, and they go, wait, there's a sharp pain in my side. Where is the EV situation stand at Sonic?
Yeah, so I mean, it's a $1 million question. It's a political question. It's a business question. It's
That's right.
My opinion is that we're in its infancy.
Yeah.
I think technology is going to get a whole lot better. EVs are probably here to stay in some form or fashion or another. Hybrids would be better. We'll get a lot more for the environment if we're producing hybrids versus producing pure battery electric vehicles.
Sure.
I think the manufacturers are wising up to that. They're producing an amazing product. It's too expensive. And so you have day supplies that are growing. Some manufacturers doing better than others, but you have day supplies that are growing, and people aren't they're not going to pay, $15,000, $20,000, $30,000 more for the same car in a battery electric vehicle than they are in an ICE vehicle.
Right.
And so we need to reduce the cost of those. There needs to be some incentives, and then the consumer needs to gain confidence in the product, in particular around mileage and charging stations and the availability of those. So the technology is going to get better. This too shall pass, but it is going to take a few years for that to happen. In the meantime, it's real choppy waters from my perspective.
Yeah, for sure. President of Sonic Automotive, Mr. Jeff Dyke, thank you so much for joining us. Really appreciate it. I know that our viewers get a lot out of your visits with us, so thank you so much, and congratulations on a great report.
Thank you, Jim. It's always a pleasure to be with you, and we'll see you next time.
Thanks for watching Inside Automotive with Jim Fitzpatrick.